Our discussion of options pricing laid the groundwork for understanding valuation. What specific impact does each factor have on an option? That's where the options Greeks come in. Let's meet the Greeks and see how they can be used. We'll begin with delta. Delta measures how sensitive an option is to a $1 change in the price of the underlying. For example, if a long call option has a delta of 0.55, the option's premium will likely increase by 55 cents. If the price of the underlying stock increases by $1. Likewise, if the price of the underlying decreased $1, the option would likely lose 55 cents. A long put might have a delta of negative 0.25. The negative sign indicates that the premium decreases when the stock price goes up and increases when the stock price goes down. Considering a long put is a bearish trade, this bias makes sense. The larger the delta, the more sensitive an option is to changes in the underlying. Delta can fluctuate anywhere between 1.00 and negative 1.00. Delta also estimates the probability of an option expiring in the money. For example, an option with a delta of 0.55 could be seen as having a 55% chance of expiring in the money. The lower the delta, the lower the likelihood the option will expire with any intrinsic value. This is where the next Greek comes in, gamma. Gamma measures how much delta may change with each $1 move of the underlying. Gamma helps you understand whether an option is getting more or less sensitive to price changes. Gamma also changes over the life of an option, growing larger as an option nears expiration. When an option has gamma risk, it has a large gamma and therefore increased sensitivity to changes in price. Now that we've covered price, let's move on to theta. Theta measures time decay sensitivity. On long calls and puts, theta is always negative, indicating the option loses value as time passes. For example, an option with a theta of negative 0.02 loses 2 cents daily. Theta increases closer to expiration, making options lose value faster. Buyers prefer smaller theta, while sellers prefer larger theta. The last of the four major Greeks is vega, which measures how sensitive an option is to changes in implied volatility. If an option has a vega of 0.01, the option's premium will likely increase by 1 cent with each 1 percentage point change in implied volatility. An option with a higher vega will be more sensitive to changes in implied volatility. Implied volatility tends to increase when a stock, its sector, or the overall market falls in price. Implied volatility is also likely to increase before events that often cause big moves in the stock price, like earnings announcements. Implied volatility quickly drops after significant events like earnings announcements. Be cautious when trading options around earnings events. There are a few other Greeks in the options world. Rho measures an option's sensitivity to interest rate changes. The Greeks can be overwhelming. In the next video, Joseph Elliott will help you understand them better.